Hi, my name is Max Riaz, and I'm from Independent Advisors WA as one of the portfolio managers here. I welcome you to your quarterly review. This one is for September quarter. The theme for this particular review in regards to the market update and how your portfolios stand, the theme will be no place to hide. Moving on to the next slide before I get going with the market update, the Independent Advisors WA have their internalized portfolio managers that deliver this particular service to you. Just a quick disclaimer that for any personalized advice, please, obviously, as you do, continue to liaise directly with Nick Stefan. So kicking off with where we're at with the markets, a good place to start is taking a look at the global view of how the share markets have moved over the past year. But as you can see by this chart, the only thing really that you need to notice, and that's quite noticeable, is that there's a lot of red here over the past month, 6 months, and 1 year basis. Over at the top, you can see the three indices representing the American share market. They're down about 15 to 25%. Over in Europe, DAX in Germany and France, those markets are down about 10 to 20%. And then you move down to the Australian share market, that's down about 12, 13% as at today. But on the right hand side, you can see the market valuations, where it just gives you an indication of, you're holding portfolios of stocks, and are they worth holding on to? Could they go down further? Generally speaking, we'd like to say to clients, in recessions, you tend to get about 20% decline in markets, and then before people start to pay attention to their price, and there's a price for everything, even in a recession, as we all know. So if you look at the ASX 200 index, it's just a market multiple. It's sort of an indicator of if the market is offering value right now for new buyers. And as you can see, 12.5 times multiple is cheaper than a long-term average of 15 times. But even on a dividend yield or income that you generate from your portfolios, they're returning that dividend yield is returning about 5%. So that's pretty healthy return for new buyers coming into the market. And we're looking at opportunities to add to our exposures. I've shown you the equity markets. Let's talk about the bond markets. Most portfolios across the market, investors hold shares, and they also hold bonds and credit in their portfolios. And as you can see, bond markets have had a decent sell-off as well. So this ties now in with what I said earlier at the outset of this presentation, that there's been no place to hide. So what are the main issues right now in the markets? Right now, obviously, inflation, everyone's talking about inflation in Australia. It's about 6.1%. But if you look at the long scheme of things, it's high, 6.1%. We haven't seen in Australia since at least the 1990s. But we're starting to see this inflation. The outlook over the next few months is that it should start to stabilize. Obviously, at the bottom, you can see the interest rates are driven by inflation. So if inflation goes up, interest rates go up. As you can see, whilst people are feeling the pinch with rising interest rates, on the long sort of time spectrum, the interest rates at the moment are nowhere near where they could be. In the past, they've averaged around 5%. The cash rate here in Australia is about 2.5%. So there's probably further room to move up in interest rates. But as I said, if inflation settles down over the next few months, which we think it will, then interest rates have probably topped out in the short term. And that should give people a bit of relief. But in terms of market volatility, obviously market, you may have read in the papers or you watch the news, share prices have obviously been volatile. They've had a few things to, sort of respond to. Share prices on the shorter term, day-to-day basis, they look at pretty much every bit of news that is coming at them, and then they respond to it. There's been talk of inflation, interest rates. As inflation and interest rates rise, share markets tend to be volatile, but once they settle down, share markets sort of do their long-term thing, which is to grow. But then there's obviously been COVID-related issues and slowdown in China and various other things. But when you put it all together, all of these sort of issues on a shorter-term basis, as has always been the case in the past, history, you can go back 100 years, there's always been wars and depressions and economic recessions, but markets tend to eventually work their way through. So if you're holding portfolios on the longer term basis, we like to say long term being 5 years and plus, then you should be okay. And right now is probably the time to actually start adding to your positions. This chart is just showing you that how ASX 200, which is the index for Australian shares, over the past 20 years or so has grown. And there's obviously been volatile times during the GFC and COVID, but as I said, it tends to work through. We are suggesting that continue to expect volatility in the shares and bonds part of the portfolio. So when you've got volatility, if you're adding new cash to your portfolios, we tend to say continue to cost average into the market or in your portfolios. That is the strategy that we tend to advocate. But if you look through your holdings in your portfolios, or the ETFs you're holding, and they're obviously investing eventually in listed companies around the globe. And if you look at those positions of a lot of the companies that we've got in your portfolios, they're well positioned. Good sector leading positions of these companies will make sure that their goods and services will remain in favor eventually when consumers do come back out and start to spend again. And in the meanwhile, these companies have got good cash positions, cash in the bank, and lower levels of borrowings to ride them out in the short-term basis and pay their dues along the way, pay the staff, pay the utilities, a bit like you and I do when we're trying to manage uncertain times, make sure enough cash is in hand at that time. So that's the case for a lot of companies. As I said, valuations looking attractive. So price of shares and bonds are starting to look quite attractive, and it's probably time to start adding to those positions. And growth over longer term, again, expect volatility. Volatility is the price you pay for holding stocks and bonds. There's always a period in the markets where you take one step back before you take two steps forward. If you took a look at the long-term picture, this is just Australian share market returns on a calendar year basis, looking back over 122-year history of the Aussie market. You can see there's lots of greens. Most years during the past 100+ years have resulted in good 10 to 20% return in the markets. There's only been really 4 years where the markets have had a pretty significant sell-off of over around 30%. But most years, if they're down between 10 and 20%, but other times they tend to deliver a decent return. And that's what you're holding out for. But you've got to hold on to your nerve kind of thing. Longer term picture of the market is very much about this century is going to be about the energy revolution. The past century was all about industrial revolution. Then there was a digital revolution. This one's going to be about weaning our dependence on fossil fuels, that is coal, gas, and moving on to renewable sources of energy. So that's where the world is moving to. And a lot of companies, there will be new companies that will emerge out of that ecosystem, will thrive. There will be EV-based automotive companies, but then there will be older companies who will also succeed, and equally there will be companies that will get competed out. So but that we're moving to a world that is now required to be by government policies which are mandating sustainability. Consumers are demanding sustainable goods and services. Investors are certainly, like yourselves, are aligning with that long-term trend. Bringing all that together in for your portfolios, your portfolios are seeking to strike a balance between financial return and supporting sustainability. You're investing in these funds to support social priorities such as diversity, gender equality, and also trying to reduce the impact of the companies you're investing in, their impact on natural environment. So we're making sure that the companies we invest in are doing that, but also delivering a decent financial return. The major thing that I would highlight is that in the Australian equities, you can see that your portfolio has a greater tilt, if I can use that term, to Australian shares because we live in Australia and invest in Australia first and foremost. So there's a lot of moving parts in the world right now. There's a lot of uncertainty. So we'd like to invest in majority home first, and then look outside. And we tend to mostly invest in advanced economies such as the US and Europe over different periods. So that's our focus in terms of asset allocations by regions. The only other thing I would add is that down below you can see the alternatives. What that basically means is, as I mentioned, markets have been volatile, and so we've added some exposure to reducing the movement of your portfolio returns through these two investment options, IDEA Real Outcome Bond Fund. They tend to reduce the volatility, and gold is just another exposure that we've added to your portfolio just as a hedge against the inflation and diminution of the currencies. So it's a sort of a preserve of wealth. So from that perspective, so that's your portfolio positioning at the moment, being home focused, reducing volatility, and being and driving sustainability based returns over near term, medium term, and long term. That's it from me, and I'll see you next time. Bye bye.